Welcome to the Bucket Plan on Demand, a podcast for financial advisors based on the best-selling book and process that simplifies financial planning. Hear from skilled industry professionals and special guests each episode that will help perfect your approach with clients and your results.
Hey everyone, and welcome to the Bucket Plan on Demand. I'm your host, Dave Allison, and I've got a special guest with us today, my business partner, colleague, and one of my best friends, Jason Smith. I think most people know Jason. Jason is a financial planner, best-selling author, speaker, and entrepreneur, really dedicated to holistic financial planning. Of course, Jason is the author of The Bucket Plan. U.S. News and World Report ranked it a top 10 retirement planning book in 2023. And I know so many of our advisors that are with C2P or have been through the Bucket Plan training all over the country are utilizing that to help educate and support clients in their retirement planning process. Also, Jason, you got a new book coming out, right?
Yeah, the Rainmaker Multiplier. Yeah.
And the Rainmaker Multiplier is really just the story of building JL Smith and the holistic business you have there.
Yeah. And both are true stories, which are parables, which make them easy to follow and fun to read versus technical knowledge.
Exactly. I was thinking this morning, I saw we had a podcast today. I didn't realize it, but God, it's been like probably 2.5 years since you and I have even been on a podcast together. It seemed like you and me were doing one like every week.
Yeah.
And then now we divide and conquer, and you're interviewing different people. I'm interviewing different people, but it's been a while since it's just been you and I here.
Yeah, it has. I think the last ones were when we did them with Bibbo. So, when we were actually doing the kind of mechanics of the bucket plan process.
And that's fitting, coming full circle to today. We're going to be talking about advising clients in volatile markets, and something that is certainly a current topic on the minds of every client out there and a lot of advisors. Before we do that, though, you mentioned the Rainmaker Multiplier book. It's been a while, and maybe some listeners haven't kept up with the progress of JL Smith. Give everybody just a high level of JL Smith. Like, what does your team look like? I know you guys had a record year last year. Tell us about some of the things that you're doing there, and then we'll jump into the topic for today and just talk about how the bucket plan helps advisors and clients navigate these volatile markets and make smart decisions.
Sure. So the Rainmaker Multiplier book comes out April 15th. And actually, I would consider it a huge favor for anybody to pre-order. We're trying to get on those best-selling lists and do a review. See what you think of it. We've had a group of people that have reviewed it thus far as the manuscript came out, and got some really favorable feedback of like big takeaways they were actually able to go implement in their practice. But what it really talks about is like foundationally how we worked on getting the holistic wealth management process, right? The bucket plan implemented, building out the front stage of what the advisor does, the backstage of what the team does, and ultimately how we develop talent within our firm through the advisor career path of going from a client service associate, maybe straight out of college, or a career change to a paraplanner, to more of an associate or service advisor at rung 3, rung 4, lead advisor or senior wealth manager, and then rung 5, opportunity for practicing partner. And how we've leveraged tax planning and management preparation as the key kind of value proposition that differentiates ourselves from other firms in our practice that's really taken us to the next level. A big part of the story is, Dave, was COVID. And we had never done virtual or online marketing or virtual or online appointments. And those were things that we had not needed to layer in until COVID happened. And from a business standpoint, COVID was one of the best things that ever happened to us. And one of the reasons is it forced us to learn how to market virtually and how to do business virtually, right? Online. And then when things came back here the last few years, we were able to go back to our in-person marketing and our in-person business development efforts, and also doing meetings in person for those that wanted to continue in that format while we maintained what we learned through COVID. And so we've doubled our production. Last year, we did 100. We have about 10 advisors now and 20 team members. 7 of them are CSAs. They're moving up the ranks to eventually become financial advisors, right? 7 of those 20. But we did 163 million of organic assets last year that we brought in, and we brought in another 100 million that was like a tuck-in of another financial advisor that joined our firm via our model at our personal practice. So we brought in $263 million of new assets last year. And the goal is to, every year it's been more. Even during COVID, we continued to grow every year. So the goal is to do that again this year and beat that 263 million.
That's awesome. And certainly so many of our offices at Prosperity Capital Advisors are modeling their business on that same success path that you've outlined there. I mean, I even know my own practice, much smaller scale, but implementing some of those same things, hiring client service associates, getting them on the advisor career path. Everybody on the team is a W-2 team member that is helping to build the business, not their own private books of business. So it's really that ensemble firm that we teach at C2P and that so many of our offices at Prosperity Capital Advisors have gravitated towards, and really trying to build enterprise value. And if anybody's interested in talking about that, I mean, for any of the listeners, my personal email address is dallison@c2penterprises.com. That's DALISON at c2penterprises.com. I'm happy to personally just share how we might be able to work together at Prosperity Capital or at C2P, but enough of kind of the commercial and the plug on that. What I really want to talk to is what set this whole business model off. I know for you, Jason, at JL Smith, is the bucket plan, right? And you got dubbed the bucket plan man by the industry, but we all know you didn't invent bucket planning. I mean, that's been around since probably before both you and I were in this industry. But, the bucket plan is really worth its weight in gold when we get into environments like we're in today, where there's an incredible amount of uncertainty. And uncertainty drives volatility in the stock market, right? When the market is doing nothing but going up and to the right and growing in value, and people open their statements and they see their account balances constantly going up, there's really no concern. Like, life is pretty peachy, especially for a retiree who needs to take some of that money out of those accounts each and every month to live off of. But when there's incredible uncertainty, whether there's economic instability, whether there's geopolitical events, whether there's administrative uncertainty around policy going on in Washington, the market gets pretty spooked, right? The market doesn't like uncertainty, and that uncertainty causes volatility. And that's when clients can start to panic. And we all know, and we've all seen the studies of behavioral finance, most of the really catastrophic, irreversible outcomes that happen in retirement are when people freak out and they panic. And like, with the amount of volatility going on in the market right now, it could make your head spin. I mean, any day you log in, it seems like the market is either up 1 or 2% or down 1 or 2%. There's individual stocks that are up 10 or 15% in a day. They're down 10 or 15%. And one of the most challenging things for advisors is just keeping their clients in their seat, keeping their strategy aligned with their long-term goals and objectives. And that's easier said than done. And the danger in chasing trades is, like, in this type of market, you can just get whipsawed. And I keep talking about that with my clients all the time. Like, they're like, should we be making trades? Should we be moving out of US and into international and emerging markets? And I'm like, the worst thing that can happen is you get whipsawed. And I'm like, do you know what getting whipsawed is in investing? It's when you sell out of one asset class because it's already gone down, you buy into another one that's already gone up, and you missed the run up. Right. And then the one that you sold out of already ends up going back up. So you sell out of the one you moved into to get back into it. And you're always chasing this thing and like you're just eating away at your wealth. And that is one of the worst things an investor can do. And the reality of it is that would pretty much be eliminated if clients just had a bucket plan, right, and an advisor that can communicate the certainty of what the bucket plan brings. Jason, talk a little bit about, like, with everything going on in the market, you're talking to advisors every single day, all across the country. What are they sharing are some of their biggest concerns right now for their business and clients in these uncertain markets?
So, Dave, as you said, we didn't invent bucketing, but I will say I think we invented the bucket plan, right? Because the bucket plan is a holistic wealth management process, right? And we invented that. And it's built around this concept of bucketing that's been around since the 80s. I think Harold Levinsky at Texas Tech was the first one that anybody could like tie back to, who really started talking about this idea of time segmentation of your goals and therefore your money, right? Your money is just a means of reaching your goals. And so this time segmentation into blocks or buckets of money and how to think about and treat that money differently, how you're going to invest it, what tax decisions you're going to make on it, whether it's going to create income for you or not, whether it's growth oriented or more conservative in nature, what type of liquidity you need available from it, all those type of things. Because as we know, the now, the soon, and later bucket, it's all completely, it's like building a complete separate holistic financial plan around each of those buckets. I started doing this concept of talking to people about their money in the now, soon, and later time frame. And ironically, I used to have these laminated sheets, and I'll never forget it, and a pack of sticky notes. And you know the story, Dave. And I would literally write each one of their accounts on a different sticky note. And I had these laminated sheets before the dry erase board when I was meeting people in their house. And I would just put the sticky notes on each one of these laminated pieces of paper with now, soon, and later at the top of them. And I would talk them through that. And the aha moment was right when the big market correction happened in 2000, 2001. And the people that we were able to, at that time, I was really just doing annuities and life insurance and long-term care. We had an investment guy we'd bring in, but I always talked to them about, hey, investment is your later bucket. That's your long-term money. But if we need income or withdrawals, we need to be able to rely on that money. And I used to put money into an annuity in the soon bucket, right? And maybe they'd have money market and some other CDs and liquid money in the soon bucket as well, and their bank accounts and et cetera in the now bucket. But as we talked through these sticky notes, that soon bucket and the people that I was able to get them really rallying behind this concept of compartmentalizing their money into a now, soon, and later time frame. They had an appropriate amount of money in the bank, right? They had an appropriate amount of money in an annuity and maybe CDs or money market that was in the soon bucket that gave them the peace of mind that they could keep taking income or withdrawals without having any stress about what was happening in the later bucket. So it was a huge difference. And I would continue to meet with people, and some clients, literally, they would just be an insurance client. They didn't do the annuity with me in the soon bucket. I would come back and see them, and they were stressed out like to the max when the sky was falling in 2000, 2001, because they didn't have a soon bucket. We didn't even call it a bucket back then, but they didn't have money in that soon time frame in sticky notes in that laminated sheet. They didn't have an annuity sticky note. And so the idea was, though, that I learned at a very early age in my career and early on is this is really powerful, right? This is like behavioral finance later on is what I learned it to be, is like control, like really eliminating making bad decisions in tough times, right? And if you have a plan, stick to it, right? If your plan hasn't changed, don't change your plan. And so that was my big first aha moment of how powerful it was to have that money time segmented in making decisions and buying a time horizon with the now and the soon money to be able to stay the course, not stress out, not freak out when there's volatility in the later bucket.
Yeah, I remember it was probably like 13 years ago, you and I were teaching the bucket plan and to a group of advisors, and you coined the term freak out risk, right? Like behavioral finance, we want to eliminate freak out risk. And there's a lot of freak out risk going on right now. But the reality of it is, if you think about the markets, I mean, Jason, going back, what you're talking about 20, 25 years ago to today, markets look a lot different. The velocity of the stock market today is insane. A lot of computerized trading, algorithmic trading, big swing bets getting made constantly. Like, one of the things I talk to clients about is there's always a reason to sell. Like right now, that reason is maybe tariffs, maybe inflation, maybe economic uncertainty. Last year, it was, are we in an AI bubble? The year before, there was something else. The year before, there was something else. There's always a reason to sell.
Yeah.
But the one thing we know is investors that take a long-term perspective are typically rewarded in a good, well-defined, diversified portfolio. But to your point, like the big objection to that then is, but yeah, I'm retired. I don't necessarily have 10 or 15 years to always let the market rebound. And I think that's where the brilliance and the simplicity of, okay, we have a now bucket and we have a soon bucket. When I'm talking to clients every single day right now, whether it's my own clients or whether some of our advisors at PCA are bringing me in on opportunities with their ultra high net worth clients, and we're reviewing their bucket plan, there's a positive conversation that's happening.
Right.
This is exactly why when times were really good in the markets, we set up and properly funded your now bucket and soon bucket. And look, even with this market volatility, right? This year so far, individual stocks can get crushed. I mean, Tesla is down 40% for the year. Indexes could get crushed. The NASDAQ is down 10% for the year. The S&P 500 is down 5% for the year. With most of our clients in their soon buckets, if they're not positive, they're around break even. That's a very positive conversation to have.
Yep.
And then one thing I got from you, Jason, a long time ago is no matter what market environment you're in with the bucket plan, there's always a positive conversation, because if it's a down market, we're highlighting how well the now and the soon bucket are doing and that we protected the time horizon. We protected their income. And we know the later bucket is going to be volatile. And then when times are really good and we're in a bull market like we were last year, of course, our now and our soon bucket, they're still making money. They're still outpacing inflation. They're still set up for growth. But we get to really highlight the later bucket that's probably putting up double-digit returns because it's in a well-diversified equity portfolio. So it's one of the things that we see the best advisors do is over-communicate during market turbulence. Right? Like I was just talking with Brian Bibbo about this last week. We were teaching the bucket plan, and he said, Dave, in the last 2.5 to 3 weeks, I have personally called every blue diamond and red diamond client at JL Smith. And for those of you who don't know, Brian Bibbo is the top advisor at JL Smith, the top advisor at all of C2P. You'll read about him in the book, The Rainmaker Multiplier, but he's like Jason's right hand and business partner over at JL Smith. And then he said, and then all of our other advisors are calling every client who's invested with us. And it's not a panic call. It's just, hey, we've been here before. We know how to handle volatility. Yeah, this time might be a little bit different, right? This situation is different, but we know how to handle it and we have a plan in place. And talk to Jason from your perspective, again, 25, 30 years of doing this now almost. Like,
Right.
What should advisors be doing right now to reassure their clients?
Dave, you hit the nail on the head. And we had this happen. We had that sharp drop right at the beginning of COVID, right? And it was like everybody was, I mean, quite literally, people were worried about the end of the world type of thing, which is the same kind of thing that has happened a number of times in the past. from a historical standpoint, but still that one was a little bit different, right? And if you remember, Dave, and I know you do, we actually put together a workshop called Weathering the Storm. And was just around a lot of what we talked about today philosophically around the bucket plan and why it's set up. Because, yeah, when we onboard a client, we explain the bucket plan. They totally understand it. Every time they come in, we review it. Their money is set up into buckets. Even at Schwab or Fidelity, we sleeve the money, right, into buckets, and they understand how their money's invested and all that good stuff. But, right, whatever Mike Tyson, that saying is, right? Everybody's got a plan until they get punched in the face. People are getting punched in the face right now. So you got to go back and you got to remind them, right? Of, hey, I love the way you just said it, Dave. Hey, we've been here. We've done that, right? This has happened before. Just know that we planned for this. This was the reason we did all the planning we did, is because we all know that this is going to happen. One time or another, it's going to happen, and it's going to last a certain period of time. Could be a very short period of time, like a quarter, or it could be even a couple of years. It could be a longer period of time. But we've bought that time horizon. We have planned for it, and getting in front of it, that's the thing. This is what differentiates the true elite wealth managers, is they're proactive versus reactive. Do you really not think your clients are thinking about you right now and thinking about what's going on in the market right now? They are. Have you called them or not? Like, just get ahead of it. Call them. The quicker, the better. And even in the bad times, you're going to get referrals because they're going to be like, oh, yeah, my advisor called me and explained this, that, and the other. And then everybody's talking about this right now. They're talking about it with their friends, their family. But when your advisor, right, their advisor, which is you, actually reached out and had the conversation, they're going to brag about you and they're going to talk about their bucket plan. And then other people are going to want one. And then you're going to grow by getting a bunch more referrals.
I mean, the biggest value of the bucket plan is it gives you a common framework to have these discussions with your clients. And I just want to share a couple of my perspectives from an implementation standpoint over the last 2 or 3 weeks. Like, the reality of what's going on in the market right now is as political as it is fundamental. There's not a middle ground anymore, right? And I think you need to just be sensitive and empathetic to that, depending on what political side of the aisle you're on. I'm having conversations with clients right now. Like, sometimes I don't get into, we've seen this before, because that sets up a counter argument like, no, we haven't. There's never been a person like this in office, and these tariffs and this and that and this immigration issue. And so don't even set yourself up for saying that. Say, I understand there's a lot of uncertainty right now. We've seen uncertainty in the market before, and that's why we plan for challenging times like this. This is exactly why we set up a now and a soon bucket, so that we can weather any of this uncertainty. I'm not saying like we've exactly seen tariffs or seen political policy or seen geopolitical risks. All I'm saying is we've seen uncertainty. And I'll share just a quick story. A client of mine, a very large client, they retired at 49 years of age. They're sailing the world on a sailboat. And so they're a little bit disconnected, other than like they have Starlink and they're on social media and posting pictures and things like that. But when a lot of these tariff issues started to blow up, they sent me an email saying, we're concerned about our portfolio. We think we should sell out of more US and move to international. And like, for me, this is what I would consider to potentially be a whipsaw trade. Nobody knows, but international is up 10% this year, while US is down 5 to 10%. So is that really the time we want to be in? And like, I had to use a little empathy and a little logic and data. So what I sent back to them is, I want to remind you of how we structured your now bucket and your soon bucket, and then how it differs from your later bucket. For this client, we actually have 2 years worth of income in their now bucket. All their cash flow needs in money market, and that's getting them about 4.5%. Their soon bucket is very diversified and managed portfolios that have some US exposure, some international exposure, some emerging markets exposure, fixed income, bonds, as well as certain private credit investments that is generating the cash flow that they need to provide them the next 5 to 10 years of very reliable income in and through this first phase of retirement. And then, of course, their later bucket is mostly equities for long-term growth. And so when I broke down a couple things, I said, your now bucket is still growing at about 4 to 4.5% because that's in government bonds. That's completely safe. Your soon bucket is actually up 0.5% so far this year when the markets are down 5 to 10%. Now, your later bucket, that is down about 5 to 6%, which is what we would expect from a long-term growth-oriented portfolio. But of your later bucket, about 80% is United States and 20% is internationally diversified. We still have a US bias. And I listed some details on why. And at Prosperity Capital Advisors, we put this information out earlier in the year. And so I just used some of the data that we had on why we have a little more of a US conviction, with US being an innovator, an innovation leader, especially in AI, the resiliency of the US consumer, right? The health of the companies and balance sheets. We talked about the international diversification. We talked about how markets in many cases are already pricing in some of this tariff stuff. And the response that I got back was exactly this. It said, "Hi, Dave. Thanks for the update on the health of our portfolio. It's at times like this when we're offshore and semi-disconnected that we really appreciate having you and your team financially taking care of us. Given everything you said, I think we're going to leave it as is for the time being." Like, that's all we need to do. Just give them a little context, acknowledge them, and to Jason's point, be proactive about these discussions. Nobody wants a financial advisor who's hiding under their desk in times of opportunity. We're proactively talking to clients about market timing Roth conversions, right? How many of your clients were fortunate enough to buy NVIDIA stock that they have in their IRA? And now that stock is down 20 or 30%. That could be an opportune time to do a Roth conversion on that stock position. Or as things as simple as just rebalancing the portfolio, right? That's how we sell high and buy low, is through prudent rebalancing. So, whether it's the performance and the stability of their income in the now and soon bucket, or whether it's tax opportunities that we could take on these market dips, or whether it's working with clients that have some gunpowder, some cash, we're going back to all of our clients, reminding them the importance of dollar cost averaging. We have had clients in the last 2 to 3 weeks that have been like, "Oh yeah, you know what? I do have an extra 80 grand in my bank account from just some savings. Let's go ahead and get that deployed." And these are creating inflows for us almost every single day. But as Jason mentioned, it just comes down to being proactive.
Yep. And Dave, your story really reiterates just the concept, or the theory is, if your plan hasn't changed, don't change your plan. And that's the thing. You built a plan taking into an account for those people that this would happen. That's what the bucket plan's all about. And now it's happened. And let's stay with the plan, because their plan didn't change. It's happening exactly like we knew it would.
Well, and I think it's really important to give people perspective. If you turn on the media right now, it feels the world's in chaos, right? And again, you see the daily volatility of the market, which is very stressful.
Right.
But even if you just slightly zoom out, I mean, as I'm looking at it at 11:47 on March 19th, I think the S&P 500 is only down 3.8% for the year. Yeah, it's a little bit off of all-time highs, but this is very normal volatility in the market. And we have to remind clients, you have to disconnect politics and emotion from your long-term investment strategy.
And Dave, just like we say in business all the time, like you can't measure anything off one quarter, right? So, but you and I are always looking at rolling 12, right? What's the market on a rolling 12 right now? I bet you it's
Yeah,
not
it's pretty
down
good.
3%.
It's up 10%.
So that's what I'm saying. I don't know. You just always got to look at and the bucket plan isn't even about 1 year. It's about 10 plus years.
And I think the last thing, that I'll share as we land the plane is what I find is important. Like I deal with a number of pretty high net worth, pretty sophisticated clients. They have the opportunity to invest with anyone in the world based on the assets that they have. The other side of it is they don't want to hear from me that I'm just sitting on my hands, not thinking about how to make them more money in these market environments, right?
Right.
Just because the client has a bucket plan in place doesn't mean we're lazy and complacent. We're always looking for opportunities to build wealth in these volatile times. Like these can sometimes create unprecedented opportunities for people, whether it's doing tax management, like I mentioned, doing Roth conversions right now, or whether it's simply rebalancing, or maybe the client's got the appetite and risk tolerance to tilt towards things that might be a little contrarian right now. They're starting to show, or there are assets that are really starting to show up as somewhat discounted and maybe opportunities
Right.
to buy. And this is the value of just having these conversations with clients to show them that you're on top of it. You know what's going on. You're watching the markets. You're thinking of how to keep building them more wealth so that they can go do the things that are enjoyable to them. Jason, any closing thoughts as we land the airplane here? Again, you've probably coached thousands of advisors on this and built a heck of a firm yourself. What are your closing thoughts?
My only closing thoughts would be if you do have a large firm that, and you don't have advisors like you described, Brian Bibbo and our whole team, we have 10 advisors. We're reaching out to everybody in our firm, at least all of our meaningful relationships and clients that have assets invested with us to have those conversations. If you're not in a position to be able to do that, right, and feel like you want to get the message out sooner rather than later, maybe dust off this perfect storm webinar that we have that we could share with you. Very relevant. Just like the key is communicating, proactively communicating. If it's too daunting for you to make all those phone calls right now, then at least get other forms of communication out and do a little webinar, do a little State of the Union, invite all your clients on it and have the conversation as a group. Those that want to have a one-on-one with you after will reach out, offer them to reach out, put a Calendly link and give them access to your calendar. But the number one most important thing to do is to reach out in these times for multiple reasons to be able to give them peace of mind, make yourself more referable, look for opportunities potentially that there could be right now, and grow your business in these times of volatility. It's the best time to do it.
Absolutely. I mean, we at Prosperity Capital Advisors have created turnkey resources for you, whether it's blogs, whether it's quick little video scripts and market intel report, giving you everything you need to just plug and play with good, valuable communication for your clients so that they can stay the course and make good decisions regarding the wealth that they have. So thanks so much for joining us today, Jason. It was fun to be back on the pod with you here. And if anybody needs anything from us, you know how to find us at C2P.
Thanks for tuning in to the Bucket Plan on Demand, brought to you by C2P, an organization whose purpose is to educate, train, grow, and support holistic financial advisors so families can achieve true prosperity. Subscribe today for the latest episodes and insights. Visit c2penterprises.com to learn how we can help support and enhance your advisory business. At the time of delivery and any subsequent publishing, information was deemed reliable but is subject to change by the time of listening or viewing. The contents of this piece include options and projections of C2P, are subject to change, and are for informational purposes only. The information provided in this presentation is not intended to be individual investment, tax, or legal advice.